Ladies and gentlemen, hello and welcome back once again to the biggest show in town, the place where we talk in trillions. Yes, indeed, it's time for federal spending. My name is Eric Kavanagh. I will be your host for this program in which we're going to try to figure out what is exactly going on with TARP, of course, the Troubled Asset Relief Program, and the fiscal cliff, the so-called fiscal cliff. I just love that dramatic name. So interesting stuff going on, folks. My name is Eric Kavanagh. Here's a thought about yours truly and enough about me. We do this in conjunction with AOL Government, so a big, big thank you to the folks at AOL Government for their support in helping us bring you this content free of charge. So we're going to have several speakers today, folks. I'm very pleased to have Amy Poster back on the show. She's a strategic advisor over at Iron Harbor Capital. Also, she was a TARP regulator, so she was right there in the mix of things, trying to make sure that all the money got to the right place in the proper fashion and so forth. And let's face it, folks, that is not a small job. So kudos to her for her commitment to our country, quite frankly, and to all of us as taxpayers. We're also going to hear from Jessica Marie, an analyst here at the Bloor Group, who has a great deal of experience in small to mid-sized banks. We're going to hear about the impact of TARP on those organizations, and our very own Robin Bloor, chief analyst here at the Bloor Group, is going to talk about money and monetary supply and what this all means, because let's face it, some really big, significant things have gone on, folks. I mean, this is not a small deal, what we just all witnessed. So I want to make just a couple of comments at the top of the hour here, and then we'll get to our speakers. So, of course, we had this crisis. There were lots of factors that came into the crisis. The price of oil was not a small factor, and if you will recall, back in 2007 in July, I believe it was, or I'm pretty sure it's 2007, that gas went up, or oil went up to $147 a barrel, $147 a barrel, from only 6 months earlier being nowhere near that price. And then, of course, eventually it collapsed, and it dropped down to $40 and $50 a barrel, and now, of course, it's back up close to $100. It's been very difficult to figure out exactly what happened there, but some theories I've heard included the fact that the big investment banks were frankly getting their clocks cleaned by the subprime housing crash and needed to shore up their balance sheets. And so what they did, according to my sources at least, was they doubled down on commodities, with the reason being that if the stock market fluctuates 5 to 7% in a day, that's a really, really big deal. But if it's just the commodities market, well, those fluctuate quite wildly all the time, and so no one would necessarily notice. So one of the theories is that we wound up with a pinch of, we wound up rather with a run on the supply of oil in the supply line. So there's only so much. You have to move this stuff around, and there was a huge spike in the price because you had all these firms betting on a very small, relatively speaking, amount of money or amount of oil in the supply line. So, of course, Fannie Mae and Freddie Mac also went insolvent. It was about a month after that the stock market collapsed, and that's when everything really started to fall apart. So what happened, though? I mean, the irony, of course, is that banks, when they work properly, make a good deal of money off of a mortgage loan. But when they don't work properly, when the loans go bad, of course, they lose money. And, of course, what happened here is so many banks were so heavily invested, not just in things like the subprime crash, but in all kinds of risky investments and a lot of these rather complex instruments. And what happened is things fell apart, the bottom fell out, and ultimately the feds stepped in with taxpayer money and bailed out all these banks. Now, there are a couple of untold stories, it seems to me, or very undertold stories, perhaps is the way to put it, namely that two things. One, what would have happened had the government not stepped in and bailed out these banks? You really don't hear too many people talk about that. Usually what you hear is, oh, everything would have fallen apart, it would have been a disaster, unemployment would have gone up to 20%, all these drastic numbers, and certainly some of that may have happened, but I'll tell you what else would have happened really. It's just a simple observation. There would have been a fire sale on assets. That's what would have happened, meaning anybody with cash would have made out like a bandit. All small banks that had good capital reserves would have been able to buy up houses and commercial properties and all kinds of things. There would have been just a massive fire sale. Prices on homes would have gone down further. Various things would have happened, but I would argue that the comeback would have been a much cleaner situation than what we have today. Because, of course, now what we're seeing is a very, very slow growth. It is a steady growth, but if you start factoring in the amount of money that's been pumped into the economy, both into the banks and just through this whole QE program, it's easy to see why there would be this sort of slow movement upwards. The question is, how long is it going to last? And the other side of the equation is, what is the impact on small to mid-sized banks? Because if you were not in a bad position as a bank, well, what just happened is the feds bailed out companies that did a bad job, and that's not a very smart way to do things. So with that, I'm going to go ahead and push up a couple more slides, and I'm going to hand it over to Amy Poster, former regulator. And Amy, I have your first slide up right now, and just let me know when we go.
Thank you, Eric. I am delighted to be on your show today. For those of you that are listening in, I know why you're all tuned in. We are going to get down and dirty. I will talk about three things. I will talk about what is TARP's price tag. I will talk about what are the monies that are not going to come back to the U.S. taxpayer. And lastly, why are the TARP housing programs a monumental failure? Let's take a look at the graph that you have up there, Eric.
Go ahead.
I wanted to point out a couple of very important data here. Out of the $700 billion that was originally allocated, that was subsequently amended by Dodd-Frank, and $467 billion have been allocated to the 13 announced programs. Of that amount, $44.4 billion of TARP funds continue to remain unspent. I'd like to point out one important detail. Of that $44.4 billion, about $40 billion are unspent housing support program funds. And lastly, another important data that I wanted to point out to all our listeners is that $84.2 billion are still owed to the taxpayers. Now, majority of these TARP programs expire between 2017 and 2020, so we still have time. But I think it's important to establish what is still owed to the U.S. taxpayer. I want to take everyone to the second slide because I love this one, because this really tells a very good story. I named it the Forgotten Main Street, and let me tell you why. If you take a look at the pie chart, the green portion there states that about 63% of TARP funds went to what I call the Wall Street bailout. Those are funds that had gone to the financial institutions, to the public-private investment program. And then, if you take a further look, about 16% had gone to the AIG city bailout. So if you add up those two numbers, about 79% of TARP funds went to the Wall Street bailout. Sadly, about 2% of those funds actually went to housing programs, and even less, about 1%, only went to small businesses. I have on my slide here the 4 main housing programs, and I'm not going to go into detail with each and every one of those, but I thought it was important to point out exactly where the TARP funds went. And clearly, it did not go to Main Street. Going to the third slide, I wanted to show what is still owed to the U.S. taxpayer as of September 30th. As I said earlier, about $84.2 billion is still owed. $22.1 billion will never be recovered. These are realized losses and write-offs that had been made to date. The largest recorded losses are on the sale of AIG and GM common stock. And this is basically because of unfavorable equity market conditions and volatility. And a lot of it has to do with a lot of uncertainty in Europe and a lot of uncertainty, with the fiscal cliff hanging. And generally, there's been a lot of volatility in the markets in the last 2 or 3 years. A lot of the losses, a lot of that $22.1 billion also is owed by smaller to mid-size capital purchase participants. This is what I still call the Wall Street bailout, who continue to experience a lot of difficulties and high losses because they have inadequate capital and liquidity. Going to the fourth slide, I wanted to show in more detail exactly where those losses are. So if you take a look at this table, this is very telling. 4.3 billion, or 19% of the realized losses actually was to GM, and a bigger amount was to AIG. It's 4.6 billion, or 21%. These were both on the sale of common stock that had to be sold at a loss. And a smaller portion, 7.6 billion, was the sale of preferred stock at a loss for 23 institutions in the capital purchase programs. For write-offs, this is basically due to the bankruptcy of Chrysler and CIT. 2.3 billion has been written off because of bankruptcy for CIT. In the case of Chrysler, about 1.6 billion has only been paid back of the 3.5 billion that was owed. So 1.9 billion had been written off. Again, these monies we are never going to see back. So it's not small change, as everyone can see. The last slide, we talk about what is in store for TARP from 2013 and beyond. And this is sort of where do we go from here also. The Office of Management and Budget and U.S. Treasury estimate that the lifetime cost of TARP is going to be somewhere about $65 billion. Treasury is estimating about $5.5 billion may still be added to that amount if the housing support programs go bust. So we're talking about $70 billion in total. The largest losses that they anticipate is going to be in the housing support programs, AIG, and the automotive support programs. The second point I want to make is that the housing support programs are going to continue to languish. And I have a table here that I am sharing with everyone to make my point. For the Making Home Affordable program, this, for everyone who are not familiar, is the umbrella program set up to assist struggling homeowners in mortgage modification and foreclosures. Only 12% of the total amount has been allocated so far. So we've got about $30 billion that's still sitting on the books of Treasury and not spent. The next important data is the FHA Hardest Hit Fund. For those of you who are not familiar, the Hardest Hit Fund is the TARP state-run mortgage modification program. And here, only about 17% has been spent to date. It's really a very sad picture if you consider the amounts and where we are at this point in time. The third point I wanted to make is, what are the current remaining Treasury investments at this point? Treasury continues to have about 16% in AIG, 32% in GM, 74% stake in Ally Financial. Now, Ally Financial used to be the old GMAC, the financing arm of GM. So the taxpayer still owns a lot of stock in Ally Financial. For the other programs, specifically the capital purchase program, there are preferred stock that the Treasury owns in 290 banks. For the Community Development Capital Initiative, or CDCI, Treasury continues to have preferred stock in 80 banks and credit unions. These are staggering numbers when you take a look at it, but I'm hoping that with these slides and with these tables, everyone has an idea where we're at this point in time.
Yes, very good stuff. And Amy, you'll stick around for the roundtable, I believe. And do you have one more slide? You want to talk about the fiscal cliff now?
Oh, hi, yeah. I thank you for pointing that out. Well, the $64 question, of course, in everyone's mind is what is going to happen if the U.S. falls off the cliff? And just sort of to explain what the fiscal cliff is, it is the end of the Bush-era tax cut extensions combined with the $1.2 trillion automatic government spending cuts on Medicare, Medicaid, and Social Security. What I wanted to point out is that a bipartisan agreement is inevitable. What I think is very uncertain is when. People are becoming very optimistic because recent news says that the President and the House Leader are in face-to-face talks, the first in 3 weeks. So we have reason to hope that they're going to come to an agreement before year's end, but who knows? They could very well have stalled talk, so we don't know. And so what I wanted to mention to everyone is that what will be the after effects if the fiscal cliff is not averted? And I see 4 things possibly happening. First, market volatility. Second, there will be a stock market sell-off. Third, and it's a very serious case, is that there could possibly be a U.S. ratings downgrade. And the fourth will be a recession for first half of 2013. I think it's important to realize if a bipartisan agreement is not forged, how devastating this is for the U.S. economy.
Yeah, and I like the point that you make that a bipartisan agreement is inevitable. Something is going to happen. It's just a question of when and exactly what that's going to look like. And
it's a
obviously
case,
yeah, go ahead.
Sorry, Eric, it's a case of who's going to blink first, from what I can gather.
Yeah, they're playing chicken with a rather large amount of money, aren't they? Oh, my goodness. This is just amazing stuff. Well, this is great material. Thank you so much. And just a reminder that, again, Amy was right there in the mix of things. That had to be a pretty stressful experience, knowing what you were responsible for. What was your overall impression after you finished your term as a TARP regulator? I'm sure you were proud of your work, but it had to be rather disconcerting, right?
Well, I think, and I shared this with the Special Inspector General, on my last day, we had sort of a quiet moment when I was saying goodbye to return back to New York, and he said one of the things that makes him most sad is the realization that Washington is basically owned by Wall Street. Mm-hmm. And the special interest groups are so powerful. And if you take a look at my second slide, 79% of TARP funds went to the Wall Street bailout. And I think if there was one takeaway that I had gotten from my experience is the sad reality that Main Street, this whole TARP bailout was really geared towards Wall Street and not Main Street, and I don't know if anyone that could disagree with me given the facts.
Mm-hmm. Yeah, it was really quite remarkable, and a lot of that goes back to Glass-Steagall, right, where that act was repealed and it allowed Wall Street bank or allowed commercial banks or residential mortgage banks to play on Wall Street, right?
You know what's even more distressing to me is the fact that not only was about 2% allocated to housing support programs, majority of the funds have still not been spent, and what is it? It's about 3 years later. So I recall that you asked me this question in our last webcast, and part of the problem is these programs were rolled out too quickly without, and understandably, they had to be quick on their feet, but a lot of the processes of this program is so flawed that it's almost impossible to really help the struggling homeowners.
Right. Well, and it's almost a marsupial approach, isn't it, too, in that when they announce these programs, there's an expectation that people are going to hear about them, understand what they mean, and then take action to go participate in the programs, and that's asking for a whole lot. I mean, when you're inside the Beltway, you can come up with good ideas and think they're going to help people, and they may in fact help people if people find out about them and actually go through all the motions to access the help and get the support that they need. But that's a long road from the moment a program is announced to anyone even hearing about it, letting alone taking the action to move forward, go to a bank, talk to a banker, get accurate information. It's just a very complex process, and I think that is one of the real hurdles that we have in dealing with these kinds of situations, is that when you try to help individual consumers with programs of this nature, that program had better be very simple, very clearly articulated, and very well managed, or it's not going to be very useful, as these numbers indicate, right?
Right. No, and, you know, to the point that you're making, and I want to highlight this, the hardest hit fund, these are the state-run TARP programs, and U.S. Treasury allocated about $9.9 billion to the hardest hit fund, and these are for states that were hardest hit: California, Nevada, Florida, and only 17% have been allocated for this program or has been spent. So, you know, they're all well-intentioned programs, but you have to scratch your head and imagine that there must be something wrong with these processes.
Well, the road to the fiscal cliff is paved with good intentions. Goodness gracious. Well, thank you so much, Amy, and stick around if you can for a roundtable discussion. Now we're going to find out the impact of TARP on small to mid-sized banks, which, again, I think is a rather undertold story. So, Jessica Marie with the Bloor Group, I'm handing the WebEx keys over to you, and the floor is now yours. Just click anywhere on that slide and use the down arrow on your keyboard to move the slides.
Okay, great. Well, thanks so much for having me be a panelist today. Amy, that was really insightful information. I'm going to be discussing the impact on community banks and just a few items. First, I'll be defining a community bank, going through some of their strengths and challenges, and the impact that TARP has had on those institutions. And really, this will be a very simple, high-level presentation, mostly based on my own observations when I was still in the industry. So first, what is a community bank? You know, there are 4 institutions that have different criteria for this. And the first, Independent Community Bankers of America, they have a criteria that between $3 million and $17 billion in assets constitutes a community bank. That's quite a spread. Our good friends at the Federal Reserve, they define a small bank as one with assets up to $10 billion. And both the Office of the Comptroller of the Currency and the FDIC use a $1 billion asset threshold as an indicator. So some of their strengths and challenges, it's clear that community banks play a very important role in the economy. And it's primarily because their business model is very, very different than some of the larger retail institutions. The foundation of their business model is relationship banking. And so they're usually very close to small business owners. And that's important because a lot of the time these small businesses have few or hard to value assets as collateral and sometimes a lack of audited financial statements. So knowing these people on a personal level is really important to their profile because it usually includes information that's not easily quantified. So one challenge that these banks have is that they have limited access to capital. The small and mid-sized banks need this capital to pay off the CPP investment, And raising that capital has been a challenge, especially with having weakened loan portfolios. And certainly they were hit fairly hard by the commercial real estate collapse. And according to some investment firms, it'll take roughly $23 billion in fresh capital for community banks to repay TARP and SBLF funds. Stonecastle Partners actually had a higher estimate of capital needs, roughly $90 billion. And I find this kind of interesting because I think it kind of shows that we may not know how much exactly they need. It might be more than what was allocated or less. So this is the most recent FDIC failed bank list, and as you can see, most of the banks on this list are small and mid-sized banks, commercial banks. It looks like all of them except for one were acquired, so I guess that's good. It didn't drain the FDIC funds, but this shows that it's an ongoing problem for community banks. They're still not stable or stabilizing. And so TARP's impact has been, my observations were that it was kind of a mixed bag. And recently the Treasury Department said that there's still 343 banks remaining in TARP's capital repurchase program, and most of them are smaller community lenders. And that's really interesting because by and large it seems that it's helped somewhat, but not as advertised. And there's still many problem banks and significantly more smaller banks that have gone under in 2010 and 2011, which kind of, leads me to question how useful TARP really was for them. On the other hand, TARP investments managed to significantly boost bank loan supply during the crisis. Although one of the things that I saw was that a lot of these banks didn't do anything with the funds. They just sat on them, and I guess it made their capital look better. But a lot of the time, these banks weren't actually using the funds to make additional loans and profit from that. It's possible that, without the $442 billion of new loans stimulated by TARP, that the economic conditions would have been worse. There was one interesting thing, actually, a friend of mine mentioned about the Japanese experience in the 1990s. It suggests that bank recapitalization programs need to be large enough to revive bank lending. So, which makes me think, actually, of a point that Amy had made about that the fact that most of these funds went to Wall Street and not Main Street and the smaller banks, and it still really shows that they're having a rough time. So there are some positive signs for the community banks through this. I think TARP's impact, it's had a direct and indirect impact, and some of these are kind of the indirect impact. It's that they've really had to change their business model a little bit and reevaluate some of their strategic planning. So, many of them, especially the ones who were involved in the residential mortgages, got some hard lessons about qualifying loans and things of that nature. So what I found was that, this was even for the commercial banks, that liquidity was more of an immediate goal. They started to keep their loan-to-deposit ratios below 100%. A lot of these banks were getting beyond 100% and really overextending. So I saw that they are kind of staying around 90% and just making sure that they have enough liquidity and So the ratios of non-performing assets remain high, but asset quality is starting to stabilize, and bank provisions for loan losses are decreasing. So that's kind of like what I've seen in the industry when I was still in it, and I tend to be optimistic that they will turn around, but probably more because of their changing business models and smarter strategic planning, more so than what TARP has possibly done for them. So
okay,
thanks so much for your time.
Sure thing. Good perspective there on impact at small banks. And you've worked at several small banks, right? 4 or 5 over the last 10 years or so?
Yes,
So you got to see the impact, at least from a couple, in terms of TARP, or was it just one bank where TARP was involved?
Well, yeah, it was actually just one bank that TARP was involved. The banking industry is very incestuous, so you know, both with other financial institutions and politicians. So it was interesting to see what was going on, you know, across the street at some of the other banks, and so we kind of we all did talk about this quite often.
Sure, and I did like the 2 little taglines that you came up with, folks, when we were planning this event. Jessica came up with 2 taglines I thought were rather interesting. Playoffs on the infamous too big to fail, which really is it's one of these monikers that is just so counterintuitive that you have to wonder how it is that we've all just allowed it to be perceived as true. But Jessica came up with too connected to fail and too big to jail, which I find rather amusing. Well, let's take a look at the whole impact on money.
Yeah, that's great, Jessica, too big to jail.
Yeah.
Well, let's see, Robin Bloor, I'm handing the keys over to you to talk about money supply, because we want to get a better understanding for what this really means, all this quantitative easing and pumping of money into the banks and so forth. And we talked briefly about how the issue related to monetary policy has not yet affected inflation, largely because the banks are sitting on the money. But, Robin, I've given you the keys, so just click on that slide and use the down arrow, and the floor is yours.
Okay, thank you for that, Eric. This graphic seems to indicate something very special to me, which is the money supply just going down a hole. If you want to kind of understand this in terms of the broad economy, this isn't in any way political. This is just, you know, economics as it is. But it's kind of worth having this as a backdrop to any discussion, because it isn't so much what the powers that be, whether they're politicians or the banking industry or whatever, have done. It's a matter of understanding the way the economies work and what kind of distortion this is to the, you know, to the vast U.S. economy. I mean, the U.S. economy is more than a quarter of the economy of the world. It's huge. So what we have here is a very simple, well, it's not simple, but it's a very revealing graphic, which goes all the way back to pretty much the First World War. And we're showing 2 graphs here. The scale on the left is for the graph that's a line, and what you see is around that 0 level, this line has gone up and down for years and years and years. We had a very considerable increase in the money supply. Going on at the end of the First World War, we had a drop in 1922 where actually the money supply was falling, and it went up during the years of the Depression. You know, and then the rate of change fell in about 1937, and then from that point it rose. And you are talking about you know, some of these are significant changes, but they don't look like significant changes on this graph, you know. And then you move along and you see that it kind of, you know, the rate of change year to year was actually gradually rising from about, well, the early 1970s is probably a good point, because that's when the link between the dollar and gold was cut. And that gave a freedom to the Federal Reserve to actually print as much money as it chose to do, or in, I don't know, in consultation with the banking industry and government. One often wonders how these things happen. But there was just a freedom to print money, and therefore the idea that the dollar, or actually any other world currency, because all the world currencies floated after that point in time, was actually linked to any measure of value, was actually gone. And then you look here in 2008 and you see this huge increase year on year in the money supply. And notice that sometime around 2010 it almost dipped down to the 0 point, but it's bounced up since then. And if you want to put a description on some of this, the description is quantitative easing. But you know, that rapid fall, or that apparent fall, after the huge instant rise in 2008, late 2008, isn't actually a fall in the money supply, it's just a fall in the rate of its increase. So all of this, you know, since in these last 4 years, has been in one way or another the money supply being, you could say the pumps were being run at full blast. Now, the shaded graph is different. The shaded graph is basically giving you the monetary base, but that has the scale on the right, and the scale on the right is a logarithmic scale. So this graph looks far less steep than if we had drawn it as a normal scale. If we'd drawn it as a normal scale, that graph would be going way through the ceiling. And that's what you say, that's the monetary base of the US economy over a period of almost 100 years. So if I go to the next slide, this is just, I don't want to go into this in any depth, because as soon as you get into chats about money supply, then it starts to become a little bit complicated. Simply because there are different measures of money. M1 is the monetary base, but it includes bank reserves. And what these things are measuring, by the way, is the impact of credit in the economy. So when you see an increase here, the increase can have come from the monetary base because all of these include the monetary base, or it can have come because people are giving out more credit. So you see M1 is, let's say, the thinnest measure of supply, but it includes bank reserves. M2 is a reasonably good measure of money in circulation. And M3, which the US government doesn't measure anymore, that's why you see a kind of green part on the graph, because the organization Shadow Stats that actually does, well, it's provided this data, but also provides a lot of other data on government activity, has kind of filled it in for us. And we see that the M3 supply, even though, you know, the monetary base expanded dramatically, the M3 supply hasn't actually, you know, which is the broadest supply of money, hasn't actually increased significantly. It's increased, but it has increased dramatically in the past 4 years. So the monetary base increased dramatically, but money in circulation didn't increase that much. So I'm giving, seeing as those are like 100-year perspectives, or bit long perspectives, I'm just giving the recent perspective, and just look what's happened. Up until 2008, the money supply was somewhere in the 800, I think we're talking trillions there, 800 trillion reason, and no, 800 billion, I think it's billions, but anyway, it doesn't really matter. It's gone up from 800 to over 2,500, it's multiplied by 3. Now, you know, in terms of straight economic theory, if, you know, we took the money supply as being constant, and we took the economy as not growing or shrinking, so, you know, the economy just being constant. And we immediately multiplied by 3 the amount of money that was in people's hands. Then all prices would go up by a factor of 3. They'll multiply by 3. You know, so anything that cost you $1 would now cost you $3. Anything that cost you $100 would now cost you $300. Because that's just what money is. It's a unit of the measure of value. And if the economy didn't change, it wasn't growing and it wasn't contracting, and we just put 3 times as much money into the economy, and all the prices would go up. And that's actually what happened in various sort of historical scenarios. Certainly happened in Germany, it happened in Hungary, when government just started printing money like no tomorrow in order to pay its debts. So we've had some kind of simple, you know, we've had some kind of similar stimulus go on in the U.S. economy over the past 4 years, but initially, immediately, as a reaction to the collapse of the banking system, or the about to collapse of the banking system. And if we go to the next slide, we look at the M3 money supply, we see that actually in terms of money supply, it hasn't really gone up much. You know, so the broad money supply hasn't gone up much. The actual monetary base has gone up in a huge way, and the only conclusion it can actually come to is that all of that money is in the banks. It's been, or not all of it, but most of that money is in the banks. We have had a little bit of inflation, but if you count inflation, it's not high. You know, it depends on how you count it, because obviously government has its way of counting price inflation. And things like, you know, that affect a lot of people, like the price of oil, that doesn't happen to get included in those measures. But even so, you know, if you measured with, let's say, the most, you know, the most effective on your personal spend, or the spend of Joe Citizen, it wouldn't have been more than about 6% over the past 4 years. It certainly wouldn't have been anything like runaway inflation. So what had actually happened is, I mean, as far as, you know, I can work out, but the evidence seems to point exactly in that direction. TARP, which was part of this, was to recapitalize the banks. And they'd been operating at very high risk leverage, levels of leverage. It was like, traditionally in banking terms, I mean, it's varied from time to time, but you were thinking of a ratio of assets to liabilities at risk of about 8 to 1. Maybe it would go up to 10 to 1. I mean, I think in recent times it kind of leveled off a little bit at 12 to 1. You know, well, most of the US banks that were actually getting into deep trouble were operating at 30 to 1. And that's just an extremely high risk level. And when it all started to fall apart, and it did start falling apart, there wasn't really any choice but to push money in those banks so the banks didn't go broke. And I mean, it's a nice idea to say that, well, let them go broke. But the problem is that the banking system is the beating heart of the economy. And if they had actually gone broke, and therefore the credit supply to everybody in the economy had actually, and it did collapse, but it actually collapsed to the point where no one could get any credit at all, then the whole of the economy would come down, and it would come down in a way that's never happened before. You know, so there wasn't any option for government to do anything other than to recapitalize the banks. It had to do it. But you hear in the news stories that go every now and then when Ben Bernanke stands up and he's doing a little bit more quantitative easing in this way and that way. And you have the suggestion that in some way or other the Fed is actually priming the economy. Well, in a certain way it is priming the economy. But all that the Fed can actually do is put money into banks, and if the banks don't lend it to other people to actually use, it doesn't enter the money supply, doesn't drive the economy, doesn't bring down unemployment. A lot depends upon, you know, the instruments of credit. And the other thing, which is, as Eric was saying, the Glass-Steagall Act had stopped there ever being any connection between money in the banking system in terms of the beating heart of the economy and money in what you would call speculative trading. Those had been set apart. Well, they weren't set apart. And the thing that, you know, they came together, and they deliberately came together because of the various lobbies in the banking system wanting the Glass-Steagall Act repealed so that they could actually get at safe money and use it in a more risky fashion. They thought they could be trusted, and it took them a whole, I think, 4 years in order to, well, maybe it's a little longer than that, but it didn't take them long for them to actually bring it down like they have historically whenever that's happened. I mean, there is no examples of the financial sector being allowed to speculate to its heart's content without it pretty soon bringing along a disaster. Whether you're looking at the South Sea bubble that happened in the UK economy, or whether you're looking at the tulip bulb mania that emerged in Amsterdam or whatever, it's always the same. It's like the people start to, smart people start to play with risk, and then less smart people get involved, and eventually it all ends up in a heap on the ground. And one of the things that happened were many large banks were in such a disastrous state of risk that they just had to be absorbed by banks that weren't in such a disastrous state of risk. And I'm sure, although I was not there, I'm sure that when there was conversations were going on in negotiations, if you're a bank and you're being asked to take over a failed bank that has a lot of liabilities, you're going to ask for pretty much rock-solid backing that those liabilities don't hurt you. So, the banks that had just fallen apart were absorbed by the banks that hadn't fallen apart. But, at the end of the day, we didn't get the Glass-Steagall Act back. So we're still in the situation where banks can, if they wish to, speculate with money that is actually within the beating heart of the economy. And therefore, we're still in this too big to fail, too big to jail situation. I think that's wonderful, that particular slogan. And note that the printing of money continued long after 2008 on the title of quantitative easing, but that just meant, as far as I'm concerned, that there were serious issues within the banking community in terms of their continuing levels of risk, and some of that had to be to stop the banks, to stop another banking crisis emerging. So the monetary base has expanded very fast in the past 4 years, and most of the money has not made its way into the economy. And the theory, and it's in one way or another talked about every now and then on the television, that the Fed is pumping money into the economy, and therefore that means that the government is issuing more and more bonds, and that's putting money in the hands of the banks, and the banks are going to lend it to people that are going to build businesses and make a lot of growth in the economy. Well, it's pretty obvious that isn't happening. You don't need to be a genius to work that out. So this is the final slide I've got, and it's kind of an interesting slide because this goes back 200 years, and we're talking about the federal debt here. Well, part of the topic of conversation here is really fiscal cliff. Well, we look at this and we see, when was the government ever indebted to its current levels before United States government? The answer is during the Second World War, when vast numbers of government bonds were issued to pay for the war. The whole of Detroit was kind of turned around to build armaments and so on and so forth. It became a command economy for a period of time, and at the end of the war, the United States economy took off and grew like crazy, and it grew at rates that politicians only dream of now. 8-9%. The kind of thing that you look into the Far East and you see, some small Far Eastern countries, or even China, actually growing at an extraordinary rate. Well, the United States was doing that at the end of the Second World War, and that didn't stop until about the 1960s. Well, even late into the 1960s. And that level of growth absorbed that debt. That's why it fell. It was like the gross domestic product was increasing a hell of a rate, and government simply wasn't issuing more debt. It was paying debt off. But you now look at the turning point. The turning point is around 1980. But I would actually say the turning point was the point at which the link between the dollar and the gold was cut. And you see year after year after year of government spending, government borrowing as a percentage of GDP because the government has been running deficits, and if you don't actually, if you don't have a balanced budget, and there's only that point in time just before 2000 there was any balanced budget going on in the United States, you don't have a balanced budget, then you are actually printing money, putting it into the economy, and you're generating what I would call a false level of growth, because it's been partially engineered by printing money, and that money will that will return to sit on your knee unless you get a growth economy, the like of which happened between the end of the Second World War and the 1960s. That would pay it down, and that's what everybody's praying for. But well, sometimes prayers don't get answered. Anyway, that's everything that I've got to say. But I'm sure we can have it's round table time. I'm sure we can have a chat about all of this.
Absolutely, and really wonderful slides, Robin. That's some really great perspective that is frankly hard to come by through traditional means, through traditional media. And it's really not all that complex, but it really puts things in perspective, it seems to me, for what has been happening with all this printing of money. And, of course, now we have this fiscal cliff looming right around us, and what is that going to do? It's just hard to say, obviously, but certainly investors don't typically like uncertainty. That's, I think, a standard truth or an axiom in the world of investment. But we've got a couple good questions from the audience. Let's see. So one of the attendees, I'll throw this over to you, Jessica. One of the attendees asks, you talked about community banks not using TARP funds to make loans, but were they permitted to do so without further impacting their debt-to-deposit ratio? Can you answer that?
Sure. One of the things that I found is that because, being a TARP recipient, there were increased or additional regulatory pressures to increase capital. And certainly with that, it did make it difficult to make additional loans, especially when we need to have more capital and we have to keep our loan-to-deposit ratio at a certain percentage. It does tighten things up quite a bit.
Okay, good. And one question for you, Robin. One of the attendees wants to know the graphs that you were showing, are they at all adjusted for inflation, and would that have had a significant effect on the shape of those graphs?
Well, I mean, these are monetary graphs, so they are the graphs of inflation.
Okay.
I mean, you see, this is actually a difficult thing to talk about, because the word inflation means two things, depending, in economic terms. One of the meanings of the word inflation is just the retail prices, and therefore the measure of the value of money in the wallet of the normal, person, or purse of the normal person. That's one view of inflation, and that's retail price inflation. But the other view of inflation is inflation of the money supply. Mm-hmm. In other words, if the economy doesn't grow and we just actually keep on pumping up the money supply, then the prices will go up, because basically, if you double the amount of money, everyone has twice as much money, and the amount of goods available are the same as they were before. So prices go up by a factor of 2. And I mean, and that's just the way it is. So you can't adjust the monetary base for inflation, because the monetary base is inflation. You could, you could take a view on what inflation has done by looking at the price of gold now, after the whole TARP thing. I mean, I didn't do the gold thing, but the price of gold shot up like crazy in the past 4 years, and it shot up like crazy because gold is the only measure that mankind has got, which is has been, for a period of 300 years, it has been a reliable measure of value. That, because basically the amount of gold created by new mining and the amount of gold destroyed in one way or another in industrial production, or simply lost, is about the same. So, the amount of gold that exists, you could have a block about the size of up to the first level of the Eiffel Tower, and about that kind of square. That's all the gold in the world, and it pretty much has been so for hundreds of years.
Yeah, in fact, I might actually share my screen real quick just to show a slide about the cost of gold. But just to throw some information out here, if you go back to 1975, it looks like the price of gold was $200 per ounce, and of course now it's almost $2,000 per ounce.
Yeah. You know, so if you want to know, if you wanted a rough guess of what's happened between those 2 points in terms of actual inflation in monetary value, then that's it. Factor of 10.
Well, and the other big question here, and this is not woven into any of the discussions I've heard about the fiscal cliff, but there is this whole concept of the U.S. dollar being the reserve currency of the world. So you've got all these different countries sitting on massive amounts of U.S. dollars. Of course, I think China is either number 1 or number 2. Japan is right up there as well in terms of sitting on U.S. dollars. And there has been talk for some time now of some countries moving to more of a basket of currencies, having some euros and some other currencies in it, as opposed to just U.S. dollars. And I guess maybe, Amy, I'll bring you back in just for any commentary you may have, but the obvious concern is if countries start dumping these dollars, then all of a sudden you've got an overflow of dollars in the market, which would lead me to believe, just by virtue of basic economics, that inflation is going to go up because you're going to have lots and lots of dollars around. You'll have what amounts to a currency asset bubble. But what do you think about that, Amy?
You know, that's an excellent question, because I still posture that the U.S. dollar is going to be continue to be the currency of choice for many countries, and I further that by saying that the world is not looking to what's going to happen to China or Europe. The world will continue to look at what's happening in the U.S. because we are still the country of which a lot of the other economic events or economic situations draw upon. And I'm not really sure about, you know, this theory about a basket of currency. I think that's why it's extremely critical for the U.S. economy to get back on its feet, because so many other economies are dependent on it. And I am very optimistic that that over a period of time, as we have in all other periods of time, will recover. That's my own personal view on that topic.
Mm-hmm. Well, certainly the U.S. has proven to be resilient, but I think one other rather troubling aspect of what Robin's graphs showed was that the other time we were in this big of a debt to GDP ratio, the United States that is, was leading up to World War II. And there's something that, Robin, you mentioned to me a couple of years ago that was, you know, one of those, we call it aha moments in this business, but it was definitely a wake-up call for me personally, because you mentioned one reason why the United States did so well after World War II is because Europe was in tatters.
You know, Eric, if I may add, one very important development which the President has actually spoken about is that the U.S. is going to be, in terms of their oil reserves, and we are going to not be oil dependent. I think the figure is 2020, which I think is going to provide a different dynamic to the U.S. continue to being a major currency. So that is pretty huge. That is very huge.
That is an excellent point, and it's kind of mind-blowing, honestly, because it's almost like culturally we've become accustomed to the concept of being addicted to foreign oil. And if you look at the amount of oil that is now largely in the back-end field out there, I think it's in North Dakota, perhaps it's way out west, there's a tremendous amount of oil. But then, of course, you have all these political issues around energy policy, and we have this pipeline coming in from Canada that they're trying to do through Pennsylvania that's been shot down. There's a lot of strange things happening, and this is, of course, just I think the reality of political dynamics impacting commerce and business and culture and life. And it'll go around and around, but kind of, I love the line that you used, Amy, that there will be a bipartisan agreement at some point in time. It just remains.
It's just when, right?
Yeah, exactly. When and what will it look like? Well, folks, we've gone through an entire hour. A huge thank you to all of you out there for your time and attention. Big thank you to AOL Government for their support of our program. And we had a lot of great comments in from various attendees, so we'll try to weave those into our post-show article. If you have any ideas for future shows, or if you know someone who is willing and happy to speak about federal spending, please let me know. Send an email to yours truly, and we'll get another show lined up for you. But this has been a wonderful event, fascinating content. Thank you to all of our speakers, and once again, big thank you to AOL Government. We will archive this presentation. You'll find it at insideanalysis.com. And with that, we're going to bid you all farewell, folks. Thank you so much. Once again, take care, and Happy New Year almost. Bye-bye.